But let's begin here. The markets and your money higher to begin the month. Happy October, by the way. So what are some of the key issues to watch as we just kind of slide into the fourth quarter? Kate Moore is here. She is Citi Wealth's Chief Investment Officer. Kate, it's great to have you on set. We're starting the fourth quarter. Markets have been hot this year. Don't seem to care about a looming government shutdown. Why not?
Well, because it doesn't tend to last very long, right? We've had like 15 government shutdowns since 1980. Most of the time, it's de minimis market impact. The one thing I do worry about, Brian, is that we have some fragile sentiment out there. People have been anxious for much of 2025, whether it's around policy or growth. And if it goes on for too long, I don't think it inspires a lot of confidence. That said, I'm not worried about it hurting earnings. And that is what I'm really anchored to in terms of our equity positioning.
Okay. What if we get some sort of crack in AI, like NVIDIA doesn't raise guidance or even, dare I say, cuts guidance? Like, what were to happen if that were to happen?
I think cuts to guidance in terms of spending or into demand projections would be really negative for sentiment.
Really negative, right?
Hugely negative for sentiment. But I don't think that's going to happen in the near term. In fact,
well, let's hope not.
All of our channel checks suggest the spending will continue. And one thing I keep anchoring to is that AI spending and investment is existential for almost every company in every industry. Will that change at some point? Perhaps. But in the near term, especially over the next couple quarters, I think the money is going to continue to flow. But you're right, this is a risk. Everyone is very concentrated in this part of the market. They own the same names, but they're high-quality names that are generating a lot of free cash flow and that are really driving and powering a lot of the innovation in the economy.
Is it true that the following two statements can both be true?
Okay.
That statement number one, AI is real, it's going to be spectacular, it's going to change the world.
Yes.
Number two, there is a chance that some AI-related stocks are overvalued.
It is possible. Right now, though, most of what's been driving the market higher has actually been the earnings story. So if we get to a place where we get significant multiple expansion with kind of flattish earnings growth there, I would get a little bit more worried. But we've seen analysts be consistently too conservative in terms of their estimates for earnings for these stocks. So they have to keep on chasing and revising up their estimates after the companies talk to them, either at a conference or on earnings calls. It is possible that some of them may become overvalued, but right now, that's not our baseline.
Citi Wealth pays you to worry, so many of your clients don't have to as much, right?
I worry a lot, Brian.
Yeah, I know you do. Well, that's your job. You get paid very well, I'm sure, to worry so your clients don't have to, or at least don't have to as much. So what is Kate Moore worried about?
I'm worried about this growing K-shape in the consumer. This is something I'm sort of fixated on, is that the aggregate data, even if it's coming from consumer stocks and earnings, or the aggregate economic data around the consumer, looks much better than what's actually happening beneath the surface. That kind of the bottom 40% or even maybe bottom 50% of households, are still facing inflationary pressures. They're not feeling as confident. They're changing their consumption patterns. And then overall consumption is being carried by the upper income cohorts. I'm worried that creates lots of fractures going forward, not just for companies, but also, of course, impacts how people vote.
It is true. We had the CEO of Malibu Boats on yesterday. He brought two beautiful boats, and he kind of said, listen.
Boats in here?
They were outside because they were too big to fit in here. They're beautiful. But he was saying that the borrower, the middle-class sort of consumer borrower who might borrow money to buy a boat, not a cash buyer, they're starting to feel that a little bit. We got Bobby Flay coming on in a few minutes. He'll talk about why, a couple pizzas in New York City is now $60 and it's probably never going down. What happens if that K-shape, rich going one way, middle, lower income going another, starts to end? Does that affect the equity market?
I think you're going to be even more differentiated in your equity exposure if we end up getting this broader spread between households and consumers who feel confident and those that are facing pressure either from inflation or from low wage gains. And I think that leads to greater differentiation, not just in the consumer stocks, but also in some financial services. I would also argue, in other parts of discretionary spend. I'll be watching travel very closely there.
What are you watching?
I'm watching
in travel.
Like non-business airfares.
Okay.
Something I'm watching.
That's what you track,
Yeah, because business.
Southwest to Orlando.
Perhaps. I mean, I'm not looking at that specific route, although now I want to go on vacation after you said that.
Okay.
But more specifically, also what happens in terms of, fast casual restaurants. We've heard from a lot of the retailers that there's been sort of trading down in some SKUs or consumers being more value oriented. So I think within the retailers, you're going to see even greater differentiation as well. So I'm watching for kind of more pair trade possibilities as a result of the K-shape.